You've probably clicked on this video to find some good ETFs that you can invest into, but ones that will also pay you a dividend to help you build a passive income. Dividend paying ETFs may allow you to build up a steady income stream, whilst allowing you diversification more so than an individual stock, which of course may help lower your risk. ETFs also tend to have lower expense ratios than managed funds, which of course means more money back to you as the investor. And also ETFs are traded like individual stocks, so when the stock market is open, they can be sold and they can be purchased. There are so many important things when you're picking a dividend ETF that you really need to consider. The first one is the expense ratio of the ETF and whether there's any other fees associated to buying that ETF. Perhaps a transaction fee or an FX fee if you're buying in your non-base currency. The second is dividend yield. Yes, granted, a higher dividend yield probably means more money coming to you as the investor, but you've got to question and look into whether that dividend is sustainable. And that leads on to looking at the dividend history. Has the company been able to sustain and even increase their dividends over long periods of time? Because this can often mean they'll carry on doing that in the future. It's not a guarantee, but it's more sustainable than perhaps just going for one that has a high dividend yield that has been known to cut their dividends in the past. And the last point is diversification. Yes, ETFs tend to be way more diversified than an individual stock, but also different ETFs have different diversification levels and they will contain different sector exposures and different companies in them. So it's always worth looking into this. We're going to be covering some of the really big dividend ETFs in this video, and some of them will be based in pounds and some of them will be based in dollars. But I know lots of my audience are UK based, so if you're watching this and you like the look of one of the US dividend ETFs, then you may be able to get it. You've just got to check on your platform. But of course, watch out for any additional fees associated. The first one up today is VHYL, Vanguard's FTSE All-World High Dividend Yield ETF. This ETF tracks the performance of the FTSE High Dividend Yield Index. In this ETF, you're going to be getting 1,814 different stocks, and these will be across the mid-size and the large cap companies. But you won't be getting any real estate trusts. However, you will be getting both exposure to developed and emerging markets. And given by the name, all of these companies will be paying higher than average dividends. At the time of filming this video, one share of the VHYL cost just over £50, and fractional shares may be available again depending on your platform. This is a Vanguard fund, so it's typically quite a cheap option. The ongoing charge for this one is 0.29%, which means you will have to pay £29 for every £10,000 invested. It's worth pointing out that if you go to buy this fund today and you notice that you're getting 5.2% exposure to this one company, that may change in a couple of years' time because the index that this ETF is tracking is regularly reviewed and rebalanced, and therefore the ETF is as well. Like I said, VHYL gives exposure to both developed and emerging markets, with its largest exposure being in North America. The sector exposure of this ETF is weighted nearly 50% across just 3 sectors. Those are financials, healthcare, and consumer staples. You're getting some of the really big dividend company names in this ETF, with the largest holding being from Johnson & Johnson. This fund is selecting those companies that 1, pay a dividend, and 2, pay a dividend higher than average. So this means just naturally it's quite selective, and this will define the sector exposure that you're actually getting in this fund, because we all know that some sectors just tend to pay higher dividends than others. Dividends from this ETF are paid out to the shareholders quarterly, and the dividend yield currently comes in at time of filming at 3.73%. Now, that's not the highest dividend yield on the list today. We have got one that is way more than double that coming up. But with this ETF, you are getting global exposure and you're getting lots of those really well-known trusted companies. VHYL has managed to grow its dividends pretty much every single year since inception of 2013, apart from 2 years, and I believe those were 2015 and 2020. In 5 years, this ETF has been up by 13.77% in terms of its performance. And if you invested £10,000 at the beginning of this fund, so in 2013, and you didn't add anything to it, you left it completely alone, Today, that would have grown to £17,000. If you want to join my Patreon, I'll leave a link in the description below, but with any of the tiers on that, you will get access to an exclusive Discord where we've already got a community over there chatting all things investing strategies, stocks, and so much more. And also, if you want a cool t-shirt like the one I'm wearing, I've designed it myself, Eat, Sleep, Invest, Repeat, then again, this is available in 6 different colors and I'll leave the link in the description. The next one we have is SCHD. Arguably the most popular dividend ETF that there is out there. This is the Schwab US Dividend Equity ETF. Like Vanguard, Charles Schwab is one of the most trusted and popular brokerages that there are out there. But the Charles Schwab ETFs in particular are really known for their great performance. The expense ratio for this one is incredibly cheap, one of the cheapest I've seen. It comes in at 0.06%, which means for every $10,000 you have invested, you'll pay just $6. Remember, if you're in the UK, depending on your platform, there could be some other expenses involved, but even so, this one's very cheap, and obviously the cheaper it is, the more money you keep. At time of filming, one share of this ETF sits at $77.95, and I should say that this ETF is tracking the Dow Jones US Dividend 100 Index. Now, you're not going to get as many holdings in this ETF as we just saw with VHYL, and you only get 103 different companies, but they are coming from a range of different sectors. The largest sector exposure that you're getting in this one is actually in information technology, but the other 2 largest are still consumer staples and financials like we saw with VHYL. And you will be getting some of the US largest, most known dividend paying stocks. You're getting your Pepsi, you're getting your Home Depot, your Coca-Cola, just to name a few. Now, you may be a bit concerned about the diversification or about only getting 103 different stocks in this one, but something that I wanted to point out here is the historical appreciation for this ETF is impressive. It has a 10-year annualized average return of 13.4%. In fact, SCHD has actually slightly outperformed the S&P 500, which has achieved a 10-year annualized return of 13.1%. Aside from the amazing performance of this one, the dividends are pretty nice as well. I'm really starting to see why you US folks out there love this one. Dividends are paid 4 times a year and the current yield sits at 3.33%. But this ETF has managed to increase its dividends for many consecutive years. Since inception in late 2011, SCHD has managed to increase its dividends for a 10-year streak. And it even managed to do this in 2020 when there were dividend cuts left, right and centre. Next up is IUKD, which is the iShares UK Dividend ETF. This fund seeks to track the performance of an index comprised of 50 of the UK's largest dividend-paying companies, excluding investment trusts. So in this fund, you will get just 50 companies, and they're all UK-based companies, which is kind of selective. But you will be getting exposure to FTSE 100 companies, FTSE 250 companies, and you'll get exposure to some of those FTSE 350 companies that have very high dividend yields. This one is heavily weighted towards financials and materials in terms of sectors, but you're going to be getting some of those companies that you've definitely heard of before. Some of the companies that you're going to be getting with this one include Rio Tinto, HSBC and BP. The expense ratio is 0.4%. They pay dividends 4 times a year with a current yield being 6%. They've not been able to consistently grow their dividends over time. They've had many cuts in the past and their annualized performance is not great at just 10 years coming in at 4.6%. So maybe this ETF is much more based on income than getting any sort of appreciation over time. I'm not going to put this next one as a separate ETF. I just wanted to point out there is a very similar one to the IUKD called the WUKD, which is Wisdom Tree's UK Equity Income ETF. This one is a little bit cheaper at 0.29%. They pay their dividends biannually. They have a very similar performance, slightly different holdings within the ETF, but all round it is quite similar. Next up, we're going to hit 2 in 1. We're going to have a US version and a UK version of this ETF. These are UKDV and UDVD, which are Spider's UK Dividend Aristocrat ETF and the US Dividend Aristocrat ETF. And they both aim to track those dividend-paying companies that have been able to consistently grow their dividends over time. They are dividend aristocrats. Now, the UK High Dividend Yield Aristocrat Index is actually comprised of just 40 of the largest UK companies that have been able to consistently increase their dividends every single year consecutively for at least 7 years. Whereas the US equivalent index is comprised of companies that have managed to do this for at least 20 years. The expense ratio on the UK version is 0.3%, and the US version is just a little bit more at 0.35%. Dividends are paid biannually for the UK one and 4 times a year, so quarterly for the US version. The UDVD, which is the US version, has 119 different holdings across a range of different sectors, the largest sector exposure being industrials. The UK DV has much fewer holdings than the US counterpart. And the largest sectors in this one are financials and real estate. Again, you're going to get many companies that you definitely would have heard of here in the UK. The US yield for this one is 2.06 and the UK counterpart yield is 4.33%. The UK version of this ETF hasn't been having a great track record. Year to date, they're up, but if we start expanding this out, 1 year they're down, 5 years they're down, and if we max it out, 2.15% since 2012. Not the best performance. However, the US version has had a much better time. 6 months up, year to date up, 1 year down ever so slightly, 5 years up by 34.15%. And if we max it out, we can see a lot nicer of a performance here than what we just saw for the UK version. The last one on our list today is JEPI, which is JP Morgan's Premium Income ETF. This one aims to provide investors with a high income whilst giving them capital appreciation as well. And it does this by investing into companies that have high dividends but also have the chance of growth. And also it tries to minimize volatility as much as possible. This fund is really promising us investors the world. But there are a few things to point out about this one. The expense ratio is 0.35%, so again, not that expensive. The dividend frequency is every single month. This is a monthly dividend paying ETF. You will get dividends paid out to you every single month of the year, which for some investors is a really, really nice steady income source. The dividend yield for this one is the biggest on the list today. It is 11.77%, which is absolutely crazy. And they're using call options to help them keep up a yield that insane. It is a relatively new fund, but it has managed to increase its dividends for the 3 years that it's actually existed for, which is kind of impressive with a dividend yield like that. You'll be getting sector exposure across many different sectors, including healthcare, financials, materials, and so on. And the top 10 holdings are including MasterCard, Honeywell, and Coca-Cola. Just having a look at JEPI's performance here. Obviously, we've got limited data as it hasn't been around very long, but over the last 6 months, it's up by 0.67%. Year to date, 2%. 1 year is down by 9.6%. 5 years it's up. And if we max it out here, we can see that it started in 2020 and we're only in 2023 now. So it has gone up a little bit, but then it's come back down. But this is mimicking what everything else is doing really. And we just have lack of data to see how this one's performing over time. Let me know if you own any of these ETFs or perhaps you're interested in some of these. And remember, eat, sleep, invest, repeat. I hope this video was helpful and I'll see you very soon in another one.